three learned professionals, Sri Rajan Vora, Sri Kanchun Kaushal, and Sri Sunil Lala. We were comparing these three just now, and the Sunil said that we are not comparable, but we are SRK. S stands for Sunil, R stands for Rajan Bhai, and K stands for Kanchun Kaushal. Friends, their CV are circulated to the paper book, so I don't want to waste your time on the technical session and you. However, you know that Rajan Bhai is heading the litigation practice. Sunil also is heading litigation practice, and Kanchun Kaushal is also heading litigation practice, and they are all in big four accounting firms. We know what is their exposure, their depth, and their influence on the opinions of the tax fraternity. But the arrangement of the discussion in the proceedings will be, the case studies will be picked up one after another by the panelists. The first case study will be discussed by the panelist one, and then there will be supplement or some comments on the case study, and then second case study will be taken up. And if chairman, of course, chairman will always have his last word on each case study. However, I would request that we resist on the floor questions at the time when the case studies are discussed. Just because we should get the maximum of the panelists and the chairman before we have any questions on the floor. And probably there may not be any question at the end of the discussion perhaps. So if there is a time available after the case studies are over, we will invite the floor participation. With that introductory remark, may I now request President Nitin Bhai to present a memento as a mark of our love and affection to Rajan Bhai. Sri Kanchun Kaushal and memento to Sunil. Rajan Bhai, mic is yours.
Good afternoon, friends. Yatin, Paresh, Rutvik, Ganesh, and many friends from the participants, organizers and participants. Hitin, so many are there. Friends, it's great pleasure to be back here for the Chamber's popular program targeted towards specialized topics like international tax and transfer pricing, which is a need of the hour. And for those who are already in practice, they need refreshing by this type of programs. And those who intend to enter into or want to excel in these areas, for them also it is a very, very good program. I think congratulations to Chamber, keep it up. I think this program needs to be continued with more vigor and should percolate down to as much as possible, because as we all feel, the area of practice which is going to be there for few more years is only transfer pricing and international tax. Friends, when Paresh called me, we are in a little difficulty, we need some chairman, timekeeper. So I said, who are the panelists? They said, Kanchun and Sunil. I couldn't resist saying yes, for various reasons. First, it is always a pleasure to listen to both of them. As we are comparing, they are both very, very good litigators. done extremely well in last few years. Open any e-journal or the hard copy journal, and you will find that half of the judgments are, half of the cases are argued by them. There are other 50% goes to councils, so they are definitely there, so that will continue to be there. But the share which is increased to the litigators has gone up considerably. Friends, it's always pleasure to be sitting with our friends, learn from them who have vast exposure in the various matters, and learn in a gap of 3 hours. You could learn a lot from both of them, who have presented such excellent case studies covering transfer pricing as well as transfer tax various facets. Friends, I think compliments to also organizers to keep this session last, because sometimes I think it should be earlier or something. They must have realized we need to keep everybody alert, if not awake. They are known to be keeping members also on the toes whenever there are difficult matters, so therefore both the litigators are here. And I am quite sure not only they will keep everybody alert, but also they will ensure that we have enough knowledge shared by them with all of us, their experience, and the various finer aspects of various provisions which many times in our conventional mind we tend to miss out. I think that's what we see. I am quite sure that all of us will be really benefited by the presentation by both of them. As I mentioned, I am here as a timekeeper and to ensure that all of us don't disturb them when they are making a presentation, so that at least we get the best out of both of them. Friends, the way we have, as Paresh mentioned, we will about have 30 minutes for each of the case study, and each one will present about 20 to 25 minutes. Then if other panelists has some additional thoughts, they will add to that. And if there are any thoughts from my side, I'll add to those thoughts. With this, I think we can start with the session so that without going into too much of preliminaries. May I request Kanchun will take first? So I'll request Kanchun to take the first case study, and then Sunil will take up the case study. One by one we'll take up. Thank you, Kanchun.
Hello.
Good afternoon. Before I start and before Rajan Bhai starts taking the time, he starts the timer. Let me take this opportunity of thanking the organizers to having given me this opportunity and privilege to be before this August audience. What I find different than the regular thing is that I have two people in front and the rest of the people are behind me. So when I see so many people in front, it makes me fear and it runs down my spine to see so many people. You are habitual to two people or maximum three right in front of you and sitting slightly higher than where we sit. It's just the opposite here. So, thank you Paresh Bhai, Jatin Bhai, Ritvik for asking me to be here and sharing this dais with senior people like you. I'll very quickly now start with the case study. In this first case study, I'm trying to highlight certain issues that I thought, and I deliberated myself with my team on royalty and fee for technical services. Though it's a historical dispute between the assessee and the department, whether it's royalty or not, or FTS or not, or a business receipt, but I'll very quickly take up this to highlight some interesting issues that I thought should be brought to the knowledge of the others also. So the facts in this relation very quickly are that there is a company in US which is a multinational IT company, and this company provides data processing services. There is a company again in US which is a FMCG company with more than 100 countries they have their operations. So they are worldwide, they're situated worldwide. So on one hand we have a data processing company, on the other hand we have a company which has existence in more than 100 countries. These two companies enter into a detailed agreement, a global agreement for rendering data processing services all over the world. Both these companies have operations in the Asia Pacific region as well as the India region. So as far as a subsidiary to the US company which provides data processing services, which you will see on the left side of the screen, they have a company called ABC Singapore, which is a subsidiary of the first company, and it provides the same services specifically to the Asia Pacific and the India region. And that is where, pursuant to the main global agreement that is dated 1st of October 2000, they enter into a specific agreement in 2006. There's a reason why I am taking the date of the global agreement as 2006, and I shall highlight that a little later in this point. So they enter into a global agreement in India because of certain statutory reasons, and the services that have to be rendered are in terms of what has been stated in the global agreement. The basic manner and the modus operandi in which the data processing services take place is that XYZ India has a number of transactions. So XYZ India could be 20 branches in 20 cities, and in 20 cities it is purchasing and selling, it may be importing and selling. So there are n number of transactions at each branch in India which are to be data processed by the Singapore company. What I want to highlight here is the quantum of transactions. They are many, they are in millions. You may assume it to be in millions. So what happens is that as a back office, this XYZ India, whatever transaction they enter into, each transaction creates an entry. And each such transaction, when accumulated for all of them, are in a raw form sent to the Singapore company. So that is what comes as point number one. It sends the raw data through the secured channels to Singapore. The Singapore company processes the data by the hardware that it has bought on its own. So the hardware which it uses in Singapore is owned by the Singapore company. There can be an interesting aspect if you have the software, which is a third-party software either provided by XYZ India to ABC Singapore, or bought by ABC Singapore, or bought by ABC USA and provided to ABC Singapore, so that uniformly that data is processed, and after this data is processed by Singapore, it is sent back to XYZ India. So if we remember just three things, there is raw data in India which gets transferred to Singapore. Singapore processes that data and sends it back to the Indian company. Here I wanted to add a little interesting point to the case study, only from a perspective that subsequently, if you will see my questions, there is a question regarding fee for technical services. So only to make it interesting, what I did was, I am introducing a few points here. The terms of the agreement, that is the global agreement that happens, that global agreement defines the right, liabilities and obligations of the service provider and the service recipient. Let me go back one slide. The service provider is the ABC company and the service recipient is the XYZ company. So what I do is that there is a detailed agreement running in a few hundred pages. Now what does this detailed agreement capture? The detailed agreement captures a situation where how the data is to be sent, how is it to be processed, what may be the form and what may be the report that is required to be done. We may jointly sit and decide what are the timelines in which I would be sending, what are the hardwares that you will use, who are the people, Are you capable of handling it? All that is detailed in the agreement. So it records the processes in which the information is to be sent, processes in which the information is to be processed and sent back, the various format. So take for example, I have to bring about a change in a particular formatting or processing of data. I have my timelines that I have to propose a change, the change has to be discussed. So all these information, there are granular details that are provided. And my purpose of emphasizing this aspect is that if such a detailed agreement is available, my question will be later on, and I'll deal with it, can it be fee for technical services? And if it can be, how can it be approached to be argued in a situation where there is a treaty and where there is no treaty? So that is the reason why I'm just emphasizing. So there are details as to the hardware, the processes, etc. They also retain a backup recovery center. What is important in all this is, and what will ultimately come out is, the entire process is done in Singapore. I do not have an access to that process. And this word access will gain quite a lot of importance when it is a question of examination regarding royalty or regarding FTS. Do I have an access? Who uses that process? Who uses that computer? Is it XYZ who uses it? Is it ABC who uses it? So all that will gain importance then. Moving on to the next, these are the questions that arise. The questions are, in terms of royalty under 916, pre and post amendment. Post amendment only because of the introduction of explanation 4, 5 and 6. And there are some interesting issues which I found them to be interesting. I would like to share and get your thoughts also, whether they are actually interesting or not. So what is the situation regarding royalty in the pre as well as the post amendment to Finance Act 2012? Royalty in terms of a treaty, I have taken the easiest of them, the Singapore Treaty. Then whether it is an FTS in terms of the treaty, assuming the services are rendered from a non-treaty country. Under the same situation, will there be a change as far as the characterization or the treatment to FTS is concerned? The last Part-1 bullet talks about, it gives a different rate. This is where the date comes into picture. The October 2000 and October 2006. Because if I take you to 115A, that is where when you talk about rate, it is 10 and 20% in terms of when the agreement has been entered into. And can there be a twist by the department, or can there be an argument by the department in terms of what should be the rate of 10 and 20? 40 is an examination in terms again of 115 of an Indian concern. So am I an Indian concern being a subsidiary of a US company in India, XYZ? So will it raise this issue of an Indian concern and I don't get the benefit and I fall under 40% if it is a case of royalty and FTS? And assuming it is a case of royalty and FTS, should I get into gross or net? Very quickly on 916, just one point I wanted to highlight, and that's bold here. Though this is where we start with the concept of royalty, I'll just read the excluding portion which says, except where the royalty is payable in respect of any right, property or information. I would only request you to concentrate on this phrase, right, property and information. So whether it is clause B or clause C, though this part is not relevant to the examination of the issue in question, but I wanted to highlight that this is where for the first time the issue of royalty arises, and this is the phrase used. Now if in this background I move to the definition of royalty in terms of the explanation too, this is where I possibly think there is something interesting that I would like to point it out. If you see Roman 1, 2, 3 and 4, this is where initially I will be concentrating. When I start reading the definition, I'll only read the bold portion in the first part, which is for the purpose of this clause. Royalty means consideration for, we will leave what is in the bracket, consideration for transfer of all or any. Now, if you remember right property of information, right is used here. And when I use the right, it is in terms of a patent, invention, model, design, formula, process, trademark. Again, the word property in the earlier portion appears as a phrase similar property. When I come to the second point, it is imparting of information, and again in relation to patent, invention, model, design, process. Again I have a phrase similar property. The third, this is where you don't have a right or information, but you have the use of that patent, design, and then you again have similar property. And in the third, you have imparting of information, and this information relates to technical, industrial, commercial, scientific, knowledge and experience again. Now, if you see 1 to 4, let us for a moment forget right, property, information. We just look at what we are talking about. My understanding here was that we are merely talking about intangibles. From 1 to 4, we are only talking about intangibles. So when we talk about right to a process or similar property, information, imparting of information to a process, similar property, use of a process, similar property, imparting of information in relation to experience and knowledge, we are only talking about intangibles. The only place, I'll come to that a little, maybe a second later. Let me just go on to the next slide and I'll come back to this slide once again. 5 and 6 is what completes the definition of the explanation, but we are not at the moment, this is not relevant as far as 5 and 6 is concerned. So I'll go back to the first, earlier slide. Now if you see clause 4a, clause 4a defines the use or right to use any industrial, commercial, scientific equipment. Here is where I am dealing with a tangible property. So first 4 intangible, here tangible. That's point number 1. Point number 2, when I am talking about property in terms of right, or I am talking about property in terms of imparting of information, I am considering that the word similar property has to be given the same color, the same natural meaning, and it should derive that meaning from what has preceded. I would leave it to the chairman because I'm not very technically savvy on the litigating part as a lawyer as to whether this principle is principle of adjustum generis or nostra res sociali, either of the two. So I leave it on to you how do you apply it. But what I say is you take the word similar property takes the color from what has already preceded. In this background, right property or information only in relation to intangibles, and when I talk about equipment, there is a right. When I talk about equipment, there is only tangible property. Now, moving on to why did I concentrate on this is this, when clause 4a was introduced, it was introduced with effect from 1st April 2002. And the purpose why it was introduced is given in the second paragraph, which starts from the definition of the term royalty. If I just read the highlighted portions for you, the result is that the income from leasing industrial, commercial or scientific equipment becomes taxable in the source country as a business income. Consequently, there is no withholding tax on such payments as the taxpayer takes shelter under the definition of the term royalty as provided in the income tax, and same is more beneficial to him. Now, what I feel, and that is how one of the Mumbai tribunals have subsequently interpreted it, that clause 4a from 2002 was actually brought on the Act to capture the situation regarding equipment royalty or equipment leasing not being able to be taxed. That was the basic intention that was brought. And if you see back again, there the intention gets completed. If you see the last portion, it says the use or right to use equipment but not including the amount referred to in section 44BB. So if you go to 44BB, there we talk about lease rent, if I am not mistaken. If we talk about lease rent in respect of machinery that is used for exploration of oil, production of oil. So the intention of the meaning of the entire clause 4A is to capture and bring into tax, within the tax fold, something which used to get missed out, and that was on account of lease rent of a tangible property. Now, getting into now the explanation. Now we have the background of what the definition of royalty is. We have the distinctions of 1 to 4 and 4A. We have the intention of why the legislature got 4A onto the Act from 2002. The date is important, and I'll come on to that date, why it is important. And now I come on to explanation 4. Now, why is the 2002 date important is that when these explanation 4, 5 and 6 were brought on record, they have been brought on record from a retrospective effect from 1476. I put a question to myself that can you intend to go back retrospectively for something that never existed in 76? 2002 is the time when it was introduced. So there could never be an intention for covering explanation 4, 5 and 6 and making it applicable to clause 4A. That is what we thought is interesting when we internally debated and to bring it. Now, to go further and to substantiate what I am trying to say as a thought, let us forget explanation 4 and 6 for a moment, because explanation 5 is what attacks royalty. Because royalty can arise either out of a use of a process or use of equipment. So in both cases, let us now see whether equipment gets covered by explanation 5 or not. There are two interesting points that I would like to highlight here. One is this, that I said that does explanation 5 cover clause 4A? That is one of my thoughts. And the second thought is, generally, and I think the department does this in the case of 147 also when they read the explanation. So the point to be considered is, can you go to the explanation and then say a 148 is justified? Or should you say that should be a reason to believe to come down to the explanation? What I want to say here is, you would be aware of this judgment of Asia Sat and why all these provisions were retrospectively changed. Because there was a lot of argument that the transponder is not here, it is out of the footprints of India, and so to cover that situation, they brought in this A, B and C and said, whether you have the possession or control, we don't care if it is such right property or information. Whether you use it directly or not, I don't care because it is right property or information. And where it is located in terms of right property information, I am also not bothered. So there could be an argument from the department that because you don't have the possession and control, because you are not using directly in your transaction, because the location of such right is outside, it is royalty. I would like to differ here. I would like to put it that unless and until I get covered by the main clause as to whether it is a consideration in respect of right property or information, if it is a consideration for right property or information, I am devoid from arguing about the location, use and the possession and control. But I cannot be forced to say that my transaction would result in a royalty because I am covered by the 3 points. So I need to come down rather than go up through the exclusionary clause A, B and C. Now, as I said, does it cover equipment or not gets further strengthened by the explanation that was introduced by the circular when this explanation 4, 5 and 6 was there. So if I see the second paragraph, I'll just very quickly read it and bring it to your knowledge. Some judicial decisions have interpreted this definition in a manner which has raised doubt as to whether, now this is to be concentrated, whether consideration for use of computer software is royalty or not. Whether the right property or information has to be used directly by the payer, or is it to be located in India, or control or possession of it has to be with the payer. I'll pause here. Till now we are only talking about computer software. If we are talking about those three exclusionary clause A, B and C, we are still talking about computer software. We are not talking about clause 4A. Considering the conflicting decisions of various courts in respect of income in the nature of royalty, and to restate the legislative intent, it is further proposed to amend the Income Tax Act in the following manner. And then they reproduce what has been introduced as explanation 5. What I want to say here is, and I have already spoken, is includes and has always included. The legislature wanted to say that this meaning and this definition always included. It not only includes but always included, and that is where I brought about the distinction of 2002 and 1976. And then they move again on the clause 2, which gives the explanation 5, and say this amendment is brought about from 76. So in the background of the interpretation to explanation 2, if I have to state in 5 lines, clauses 1 to 4 only talk about intangibles. Clause 4A talks about tangible. Clause 4A got introduced in 2002, not in 76. It had a different intention, and that intention in this entire circular has not been referred to. So can I stand up and say that this circular is independent of the 2002 circular? To strengthen my argument that explanation 5 will not apply to clause 4A at all. This is regarding the FTS part, explanation 9172. It's simple. It says rendering of managerial, technical or consultancy service. I'll come to this when I examine the questions. And the Singapore Treaty I have taken only for the concept. I'll very quickly just explain the concept of make available. So we'll come to this later on. Now in this background, if I take you back to my questions, royalty under section 916 pre-amendment. Now the question comes. Now we go back to the facts. The facts are that XYZ India has a number of transactions. It sends raw data. Now to explain it, let me pictorially say that the raw data travels and outside Singapore it stays. Nothing happens to the raw data till the time the Singapore company retrieves that information into the computer. When it retrieves the information into the computer, it has a lot of importance. It processes the data. I don't have an access. Then it remits back the processed data, and I do not do anything till the time I open my computer and retrieve it. So these are the 3 steps that come in. In such a situation, I do not access, I do not use the process, I do not use the equipment. The process and equipment is used by the Singapore company for its own business to provide standard service to me. The question raised in AsiaSat was similar. Is the customer using the transponder, or is it the transponder or the satellite owner using that for its own business to provide a standard facility? The moment the question arises that I, as a service recipient, if I am using that process, it is royalty and I have no other case. Because either I am using the process or I am using the equipment. So if I sit here today and I transact, I sell a product to you and I punch the computer and the process happens and comes back to me, I am using it, it is a case of royalty, the consideration is royalty. But if I am just sending the data and it is being processed there and I come with the result is the processed data to me. Say for example, I send my cash transactions and I get a cash book. So I don't press the data, the computer here to get my cash book and all my transaction processed. If I do that, it is royalty. If I don't do it and they do it, it is business income. Then the concept of a permanent establishment will come. If there is a permanent establishment in India, it is to be taxed, otherwise it will not be. Post-amendment, if you see my explanation in terms of how I wanted to interpret clause 4, the explanation 5 and its application to the definition, here again, explanation 5 does not apply to equipment, so it cannot be equipment royalty. I am out of the situation that it is a royalty in terms of machinery. Now what is left is just the process. And till the time, if I read it properly, that right property and information is a consideration for right property and information, I don't get covered by the fact that because I don't directly use it, I don't have its possession, it will not be a royalty. So in case of pre and post amendment, both in terms of process and equipment, I personally feel it is not a case of royalty. In case of Singapore Treaty, I have brought it basically of looking into that. Oops. Sorry. So both in terms of the treaty, I'm sorry for this glitch, I'm not very tech savvy. We still read it from the ITR and not on the, and mark it with red and blue pen and ink, and then you try and remember. It's difficult to remember here. So the first two bullets, it's not royalty. FTS, now if I tell you what I spoke initially, that there is a detailed agreement. Can it be said that it is a case of fee for technical services? Now, I thought if this situation is given to me, how would I argue? This was a question to me when we were making out this case study also. What came to my mind instantly is something which I read as a line in Morgan Stanley, that there are a number of times when you transact with each other at this level, there are certain commercial reasons why you bring in certain clauses into the agreement. So if one has to put across this case, you remember that I am a company XYZ, the service recipient is a company which has existence in 100 countries. Now if I am such a big company, as a CFO or a tax head of that company, where will I go? I will go to the person who's the service provider and put a question. Do you have the capacity to do my work? This is what I'm trying to point out from the FTS point of view. I'm trying to give you a practical answer, that what I thought was a practical. So I go up and I interview that person and I say, can you provide me with this service? Where all do you have your offices? Do you have the capability? What is the internal control that you're going to put? If I send you the data, how would you process? Which is the equipment that are you going to use? Is this the software that you will be using? What is the advantage of this software? Now I put a question to myself, who's providing this information? We as tax heads are sitting across, or consultants, sitting across and discussing with the service provider. So what contains in the agreement is nothing. He's not provided me something, neither have I provided. Both of us have provided so that the transaction happens in the right form. So it is nothing. Fee for technical services will be a consideration where such a service is being provided to me. Here we are discussing, we are sitting across. Will you put this as an internal control when I am sending the data? I have a lot of IP products. This information is not required to be leaked. What is the confidentiality that you are going to put? What is the process there? If I want to make a change, if you want to make a change, what are the timelines? What are my rights? What are my obligations? What are my liabilities? And in terms of that, when you are providing me the service, what is your right, liability or obligation? So what is contained in the granular form in the agreement, whether it relates to hardware, software, the people who are providing the service, I would never like the people to be, there should not be attrition in the people. If there is an attrition in the people, who's the person who's going to head? Where is he going? Why is he going? So we put everything in that. There is no technical service. So now in this light, if we see the definition of fee for technical services, it is rendering of managerial, technical or consultancy service. Is he rendering? He may have the technical knowledge, he may have the commercial knowledge, he may have the managerial knowledge. But what does that knowledge lead to? It leads to providing a service. He is not providing me technical knowledge. He has technical knowledge to provide me with the service. So, in light of this, the answer to FTS is that it is not in terms of FTS also, it is not a FTS, it is a business receipt. Assuming that this is from a non-treaty country, so what gets cut is only the concept of make available. So even if it is FTS in terms of Singapore, is it making available? That's the advantage one gets in terms of a treaty. In terms of say Hong Kong or any other country where it does not happen, where there is no treaty, I still assume, if I go on this practical concept of there is nothing provided in the agreement from his side or my side, there is no technical information or commercial information, it is something which we've discussed across the board. I may have suggested 20 things, he may have suggested 20 things, and out of that we like 30 and put it in the agreement. So I have 30 schedules and a 30 format and a 300-page agreement running in the process. But there is no fee for technical services. Now coming very quickly to the issue of royalty and FTS in terms of rate. Am I able to do that? Yeah, please. Coming within the rate, here is where the importance arises regarding the date of 1st of October in 2006. Because if we go on to 115, if I fall in clause B or clause B read with capital A and double A, that is where if the agreement is between 97 and 2005, the rate is 20%. If the agreement is after 2005, it is 10%. So if I am falling within the domestic act, can I say I should get the benefit of 10%? Because I have a India-specific agreement. There is an agreement at a global level. That global level takes into consideration the statutory position in all the countries. It has India mentioned as one of the countries there. For India, I enter into a specific agreement. I take the statutory approvals, say under FEMA or under FIPB or RBI, wherever the statutory requirements are. So can I take this argument that according to me, yes, I can take the argument, though the department would like to say that your agreement subsequently in 2006 has been derived from the agreement of 2000. So that is where this aspect is highlighted. And getting back to the last part of this is 40%. That's a great controversy which is going on. So I would not like to add a lot on that. There is a board circular, not in terms of royalty, where an Indian concern has been defined. There is a Mumbai tribunal judgment which is in our favor, where a concept of Indian concern has been defined. But on the contrary, and unfortunately, we have Bombay High Court way back when globalization was not there, when this concept of royalty and FTS did not exist, or did exist but did not have so much emphasis, where they decided the concept of Indian concern against us. And we cannot run away sitting in Maharashtra, we cannot run away from those Mumbai High Court judgments, but we can surely put in across to the court, whether it's the first appellate, second appellate, or the High Court, that it needs to be seen from a different angle now with globalization and situations like this. And assuming the rate to be 40%, whether gross or net, my personal opinion is net. But the difficulty that arises in net is that you generally don't comply with the TDS, so that problem comes. But yesterday I did look into that Article 7.3, though it's not reproduced, but I looked into Article 7.3, and I thought of a argument. It just struck me that it does have a particular language where it says that when the profit is to be attributed, the expenses could be either in the state in which the permanent establishment exists. Now the important word that I found there, and I think we can develop some argument, is or elsewhere. So does the domestic law, as it has been interpreted, it says the moment you get into a gross or net position, the domestic law applies. That's the present interpretation. But I was not able to lay my hands where we thought about this to project 7.3 in a completely, Article 7.3 in a completely different form on just first principles, on reading of how it appears. And there I felt we can take a thought, and subject to what the chairman would like to speak and Sunil would like to speak on, can we say that the expenditure incurred in the state of permanent establishment or elsewhere, and the law of that state is to apply. So the word is law of that state. Expenditure incurred in the state in which the permanent establishment exists or elsewhere. So can we relate that state to the place where the expenditure was incurred? If I relate it to domestic, I get caught under 40 AI. If I am able to run out of it, then according to that country, if I am giving you an India-specific account, I should be taxed at net on 40%. Thank you.
Thank you, Kanchun, for brilliantly explaining the controversy, or to bring out the controversy to the table, so that at least we start looking from that point of view. Sunil, you have anything to add, sir? Okay, I'll just share 2 minutes because I think almost I subscribe to all the views which Kanchun expressed. 1 or 2 supplementaries, I would only say supplementaries, which could be considered. And I like the idea of not touching the case law, but going to the interpretation of the law. But the interpretation of law first, and then see whether there is any support required. I think that is the basic principle. Just when I started at the beginning of the learning of international tax law, all what I was taught was every income first is business income, unless it falls in salary or any other clauses. Then we have to see, is it excluded from that business income by a specific provision, like whether it is royalty, whether it is for FTS. So as Kanchun rightly said, we have to first see whether this income, which is a business process or data processing services, is it a business income in the hands of recipient under the Indian laws, whether it could be treated as business income or no. If we analyze, and as he rightly articulated, this is the activity which is carried on is a business activity which is carried out by him in Singapore. So he is carrying on independently without dependence or without interference from the Indian concern. So therefore, when the data is transferred, it is he who is processing on his account what we call it on the independent basis. So therefore, he is carrying out the activity not on behalf of somebody, but he is carrying on his own behalf and returning back to you. So therefore, it is a business income. Once we come to the conclusion it is business income, he is using his hardware, he is using his software, and he is using all his infrastructure. Question is, once we come to the conclusion it is a business income, then we have to see whether it can be carved out as a royalty of fees for technical services, and which he rightly elaborated as to what is royalty, under what clauses, sub-clauses which could come, whether the explanation which are added, explanation 4, 5, 6, whether that could override retrospectively, and it could not be, as he rightly pointed out. Coming to the FTS, again I think make available is a very, very important clause which you keep in mind, because many times it comes to our rescue. Because make available is, are you passing on any technology to the person who is receiving it, or is it only executing on the basis of technology which he purchases, and which is what he rightly articulated. He is executing with the technology what he has. So therefore that does not mean, so whether under Act or under treaty, it really does not become FTS or royalty, it continues to be business income. Once you come to the conclusion that it is a business income, then the next question is whether it will be taxable under the Act or treaty. Where will it be taxable? If you don't have a P in India, question of taxability in India doesn't arise. So therefore, again, no question of Singapore company getting taxed in Indian company. So therefore, these aspects need to be considered. But even if there is no treaty, once we come to the conclusion there is no P or no business connection, merely because doing a job for Indian company does not become P or business connection with you. So the regularity doesn't become a business connection for the purpose of taxability of Singapore company in India. I think these are the broader aspects we need to consider. Just for, as I mentioned, he has done brilliantly. Just for your consideration, you may note down 3 or 4 case laws which could be helpful. Those who want to really get into more details on this aspect. Standard Chartered Bank, which was successfully argued by Kanchun himself before the Mumbai Tribunal. Slightly different, but there are a lot of material you could get on analysis of what is royalty, what is business income. Second is AR decision of RR Dole. Again, it was a question of a processing of data in UK. This was almost a similar, but UK. Singapore treaty is better than the UK treaty, but even under UK treaty, it was succeeded.
Can you repeat, sir?
RR Dole. I think 335 ITR. Citations I may not be correct, but you can check the names with it, you can get it. AR decision. Third is Kotak Mahindra Primus. Again, Mumbai Tribunal. Again, very, very important decision which lays down certain principles. And fourth is AsiaSat, which is referred to for the purpose of equipment. But some disturbing observations are found in recent Madras High Court decision in case of Verizon. So you must, when you look to the AsiaSat, also look to the Verizon, just to compare whether it is creating any difficulty in whatever we have understood, whatever we are arguing. Is it on the same lines? Is it making difference? I fully subscribe to the views expressed by Kanchun that under the old law or even after amendment, this does not become royalty of fees for technical services. It continues to be business income and it cannot be treated as PE on the facts which are given. So therefore, all answers. One more point which I think many times we try to miss out is the amendment carried out because of the non-filing of a PAN number by the foreign party, the rate changes. I think that when there is a treaty, no treaty, all those issues we need to consider and grossing up. I think many times we make a mistake of not grossing up and then cost considerably higher. So therefore, these 2-3 aspects, when if at all it is held to be liable tax, then we must look into these aspects also. Since he has already raised whether 10, 20, 40, so all those aspects we need to consider. I think with that we can request Sunil to take up his first case study.
Thank you, Rajan. Good afternoon, friends. At the outset, let me just take a minute before I come to the case studies. I would like to thank the Chamber for giving me this opportunity to come before such a learned audience. I can vouch for that since I know most of you. I'd also like to thank the Chamber to give me an opportunity to be on the same dais as Rajan Bhai and Kanchun. Many of you may not know that our 3 firms have been competing with each other since decades, but we have never been competing with each other. That's PwC, KPMG and EY. And since some months now, there has been a change in my status. I am now part of Advaita Legal, as you notice on the screen. And I was missing being in the elite company of Rajan Bhai and Kanchun. But thanks to this, I've got this opportunity to share the dice with them, and I thank the Chamber for this. And Rajan, thank you very much for your kind words of introduction. In fact, your introduction reminds me of another quote, which says, "A great man shows his greatness by the way he treats gentlemen," and when I say gentlemen, I mean the way you introduced me. Thank you very much. As regards my case studies, I may just want to point out 2 or 3 things. I've taken about 4 case studies, and in all, the mammoth task has been, I've tried to cover 12 issues in these 4 case studies. Out of these 12 issues, all but 1 are actual real cases where we have been part of arguing these matters, and I will tell you which is the one which we have not argued. And the PPT which I have made, for a moment when you see it, you may feel there's an overload of information, there's a lot on the thing, I may be skipping a lot of slides, but the PPT is made in a manner of it being self-explanatory, that should you want to revisit it after a few weeks or a month, and I'm sure this will come on the Chamber's website or a mail, that even without my any presentation, you will be able to understand it. So that's why the presentation is long, but if I skip a few slides and I go fast on a few slides, please don't feel cheated, because this presentation will ultimately come to you. Let me come to the first case study. So this is a case there are 3-4 issues here. The first one being the capital gains taxability. So the facts are, PR Limited UK has a subsidiary which is PQ Netherlands, which in turn has a 60% shareholding in A Limited. Now, this PQ Limited transfers this shareholding in A Limited, which is an Indian company, to a Mauritius entity, which is PS Limited, and Mauritius entity in turn further transfers it to XYZ Limited, Mauritius again. This is a particular transaction. The relevant dates here are that PS Limited was incorporated on 1st December. It took a loan from Netherlands, and with the same money it purchased the shares of the Indian company from Netherlands, and the very next day it transferred these shares to XYZ Limited, Mauritius. So these are the facts, the relevant dates for PS Limited, Mauritius. If one goes to the relevant date for XYZ Limited, Mauritius, the relevant part is that when this transaction took place, for those 4 months, I've just changed it from 1st October to 10 December, when this entire transaction took place, the director of this company was only one person who was an Indian resident, and this is a real particular case. So when this transaction took place, the control was really in India of this, in that sense there was one director on it. The issue now arises as to in this particular transaction, who would be taxable, if at all anybody would be taxable. What would be the case in the case of PS Limited, Mauritius and Netherlands. Now, this is the issue. If one really goes to the obvious thing, if one goes to the Mauritius Treaty, and I will not be referring to the article number, section number, rule number, circular number, all this will be there with you. If really one goes to the treaty, then obviously this transaction cannot be taxed in the hands of the Mauritius company, and I need not explain that why. We all know that Indian shares and sold by Mauritius would not be taxable. When if one goes by the circular, or if one goes by Azadi Bachao, obviously this amount would not be taxation. Now the problem is created by Vodafone. Vodafone says that despite the circular, despite the treaty, if the department feels that there is a conduit company, the Mauritian company is a conduit company, they can look through the transaction and therefore deny the treaty benefit. Till here it is simple. The issue arises, so in our case, obviously, since the first Mauritius company came in only for those 3-4 days, it was for this particular transaction. Obviously, I think there will be no doubt that this is a conduit company, and therefore the treaty benefit would not be available to the first Mauritius company. The issue arises, what happens then? You can't just stop there. If you're having a particular, you're holding a transaction where on paper the Mauritius company has sold the shares, and you say, no, I will not give you the benefit of the share because you are not the true seller of the shares, then you must take your allegation to the logical conclusion that there is at least some seller. If it's not the Mauritian entity, then you go to the Netherlands entity. If one really goes to the Netherlands entity, then you are concerned with the Netherlands Article 13, Para 5. What that says? It says any gains from the alienation of any property shall be taxable only in the state of which the alienator is a resident, which is in this particular case Netherlands, so then it will be taxable in Netherlands. However, gains from alienation of shares issued by a company resident in the other state which shares form part of at least 10% interest in the capital stock of the company, may be taxed in the other state, which is in this case India, if the alienation takes place to a resident of that other state. So really the issue would arise whether this amount would be then taxable in Netherlands or in India. For it to be taxable not in India, it becomes critical that XYZ Mauritius is considered to be not a resident of India. Now, as I mentioned earlier, when this transaction took place, there was only one director in XYZ Limited Mauritius, and that one director was actually a resident in India. And the department actually alleged that though this is a company of Mauritius, the control is really, when this transaction took place, it is in India, and therefore even the Netherlands company will not be given the treaty benefit. Because, even if it's given the treaty benefit, since Mauritius company, the control is in India, it will be taxable in India. The issue for consideration is therefore whether that XYZ Limited can be considered to be a resident in India. So if one looks at section 6.3, which is the third bullet, that says a company is said to be a resident in India in any previous year, if it is an Indian company, or during that year, the control and management of its affairs is situated wholly in India. Now, one may argue, and this was actually a real case, where at that particular point of time when this entire transaction took place, was 3-4 months, there was only one director, frankly everything was happening in India. But we said, look, this section says during that year. So one really has to take into account the whole year, and if one sees the whole year, maybe for part of that year, the entire control and management could be in Mauritius, but when you look at the whole year, when the transaction took place, maybe the control and management was in Mauritius, but during the relevant year, if you take, there were 2 more directors during the relevant period, and therefore, the control and management during that year cannot said to be wholly situated in India. On this, we have a couple of decisions also, which says that if any, the underlying part, if any part of the control and management is outside the taxable territories, then the company would not be resident. In the case of a company, any measure of control and management of its affairs outside the taxable territories would make it resident, would make it non-resident. There are other decisions also on this particular point, which says if the day-to-day affairs are outside of India, the meetings are held outside of India, as in our case, then in such a situation, you cannot say that that company is a resident in India. And the tribunal appreciated it, and they said even if the transaction took place at that point of time, apparently the control was outside of India. It was in India, but for the whole year it was outside of India. It could not be taxable in India. So that is as regards the first case study. Now, A Limited has also had 3 more transactions, and I will discuss the first one right now, which we will deal with. A Limited has paid a dividend of rupees 5 crores to PQ Limited and has paid a dividend distribution tax at almost a 17% rate. Or has not paid, is contemplating paying, and A Limited wants to know whether it can claim the treaty benefit and take a lower DDT of 10%. That's the issue. We've done some research on this, whether Article 10 or whether the treaty would apply to DDT. We've not come across any case law in India on the point. We had argued a case, but the matter was set aside to the file of the AO to look into the arguments which were taken. So I'm not aware of any precedent on this point. But nevertheless, on first principle, let's see what the stand should be. Now, if one really looks at Article 10 of the tax treaty, in this particular case, Netherlands, Article 10 says, dividends paid by a company which is a resident of one of the states to a resident of the other state may be taxed in the other state. However, such dividends may also be taxed in the contracting state of which the company paying the dividends is a resident, in our case A Limited, and according to the laws of that state. But if the but it should not exceed 10%. Now the issue which arises, the words are such dividends may also be taxed according to the laws of that state. The issue would really arise whether the tax which is paid on the dividend, what is the dividend distribution tax which is paid by the paying company, can one say that the dividend earned by the recipient is getting taxed? That is the issue. If the answer is that the recipient of the dividend is effectively getting taxed, though the dividend distribution tax is being paid by the company, then there may be possible to argue that the Article 10 benefit should also extend to dividend distribution tax. So the real issue is whether DDT paid by the paying company is taxed on dividend as far as the recipient is concerned. So if one goes to section 1150, which talks of dividend distribution tax, let's see what subsection 1 says. Notwithstanding anything contained in any other provision of the Act and subject to the provisions, any amount declared, distributed or paid by such company by way of dividends shall be charged to additional income tax, hereinafter referred to as tax on distributed profits at the rate of 15%. So it says whatever DDT is shall be charged to additional income tax. Subsection 2 says notwithstanding that no income tax is payable by the domestic company, tax on distributed profits under subsection 1 shall be payable by such company. And subsection 4 says that the tax on distributed profits so paid by the company shall be treated as the final payment of tax in respect of the amount declared, distributed or paid as dividends. On a reading of this, it seems there may be some scope to argue that DDT is nothing but tax on the dividend. And if you take it to the logical conclusion, therefore the Article 10 benefit should have been applied to a DDT. But this is just a plain reading of the section, and really let's see whether one can really make a stronger case to say DDT is tax on dividend. So if one really looks into the history of this matter, in 1997, when the Finance Act says, the memorandum said, abolition of tax on dividends and introduction of tax on distributed profits. And I'm quoting from there, it says, many a time the tax deducted or a part thereof is required to be refunded to the assessee. Thus, the procedure for tax collection is cumbersome and involves a lot of paperwork. So the reason why they changed this thing was just to make it procedurally more simple. Similarly, the circular said the existing provisions, as per the existing provisions, corporate dividends are taxed in the hands of the shareholder. The existing method involves a lot of paperwork. Therefore, the Act now introduces a new system of collecting tax on profits distributed by companies by way of dividends. So really one goes by the memorandum, by the circular, one can infer that DDT is nothing but tax on dividend. If one goes then to 2002 Finance Act, that was 1 year when the DDT was abolished and tax on dividend came in. And at that particular point of time, the explanatory memorandum to the Finance Bill said that the incidence of tax should therefore be on the recipient. Moreover, the present provisions of levy of tax are a flat rate of 10% on distributed profits across the board, irrespective of the marginal rate at which the recipient is otherwise taxed. And then the circular further said that the earlier system of taxing dividend has been reverted to, and the incidence of tax has been shifted back onto the shareholder receiving the dividends. So if one really goes to the history, one will notice that either there was tax on dividend or there was a DDT, and each time the law changed, it changed for procedural purposes. If one goes by all this, and if one takes certain help from certain case laws, now this was a case wherein it was held. This was a case of section 115JA. This is not a case of dividend distribution tax, so to say, and the treaty, but this was a case where they held, this was for the purpose of MAT, where the DDT can said to be income tax and therefore to be added back. The tribunal held that the legislature, in their wisdom, thought it fit to collect tax in the hands of the company itself instead of collecting tax on various individual shareholders, just the bold part. Therefore, the legislature shifted the burden of paying the income tax by the individual shareholders to the domestic company which distributes profit or dividend. Therefore, what was collected by the revenue as tax on distribution of profit remains to be tax on income. In our opinion, merely because the tax on profit distributed to shareholders was levied and collected from the domestic companies, it will not lose its character as tax on income. Similarly, there is another case of the Mumbai tribunal where the same logic has been followed. And if one really goes by the memorandum to the finance bills when the law changed, if one really goes by the case law, and there is no direct precedent on the point, there may be a scope to argue that dividend distribution tax is nothing but tax on income, and like any other dividends, it should also get us the margin, the beneficial rate under the treaty, which right now would be 10% as compared to almost 17% under the Act. Coming to the third issue, which is a case of type testing certification charges. So A Limited is paying to a German company certain type test certification charges. The German company has a huge laboratory, there is huge sophisticated equipment lying there, and everything is automated. In the facts of the case, which I will come to later on, the only human intervention was the person putting on the switch, putting the particular short circuit or whatever before in the sophisticated technology, and there would be an automated reading, and that automated reading would really give the results of the test. But the laboratory, which was highly technical, highly sophisticated machinery was used, and the issue arose whether this amount paid would amount to fees for technical services. If one goes to the Act, then explanation 2 to 9(1) talks of fees for technical services, which says fees for technical services means any consideration for rendering of any managerial, technical or consulting services. This particular laboratory in Germany is not doing any consulting, is not doing any managerial. The issue is whether it is that particular service of type testing amounts to a technical service. Now, if one goes to the German treaty, unlike the other favorable treaties, it does not have the make available clause. The German treaty for FTS is akin to the Indian Income Tax Act, and the article reads as payments of any amount in consideration of services of managerial, technical or consultancy nature. The same words are used in the treaty and the Act. The issue arises whether a particular service which is being rendered by using highly sophisticated technical equipment with minimal human intervention, can that service amount to a technical service? So as against the person doing much of the work, it's the machine doing most of the work. The person is just switching on the button and switching off the button. Now, really, if one applies the principle Kanchun mentioned to this of nociter sauces, the word technical is coming between two words, managerial and consultancy. Now, one can never have a managerial or a consultancy service without a substantial human involvement. Or let me put it this way, without a substantial involvement of the human brain. So both these, for managerial and consultancy, you need an involvement of the human brain. Now, if really one applies the principle of nociter or sauces, that even for the technical service, there must be substantial involvement of the human brain in rendering that particular service. So really, if one goes by our example, then the involvement in our hand is maybe that of a human hand, to the extent of switching on, switching off the button, and really all the work has been done by the machines. Therefore, it may be possible to argue that this is not fees for technical services under the Act also. We have number of decisions on technical services which talk of sophisticated technology, etc. cannot be the basis to hold it to be technical. However, directly on the issue of testing charges, we have these 10 or so decisions against on the point. All these decisions are against on the point of testing charges. But somehow, strangely, none of these cases, the issue of human intervention was argued. Maybe the case of Bharti Cellular was not there at that point of time. After all these decisions came a case of Siemens, where Siemens considered all these decisions, these 10 negative decisions, and said, in those cases, the argument of human intervention was not taken. And this is what Siemens held. On the contrary, if any technology or machine developed by human and put to operation automatically, wherein it operates without any much of human interface or intervention, then usage of such technology cannot per se be held as rendering of technical services by human skills. Merely because certificates have been provided by humans after a test is carried out in a laboratory automatically by the machines, it cannot be held that services have been provided through human skills. So here they made a distinction between human, if you go really deeper in the judgment, it's a difference between the human hand and the human brain. For managerial and consultancy services, clearly the human brain comes into play, and therefore for technical services also, it's the human brain which must come into play and not just the human hand. And if the human brain does not come into play, really there is no scope to say it is technical services even under the Act, notwithstanding the fact that sophisticated technology has been used. After Siemens, we have a few decisions following it, not for testing charges, but for other, where the same principle has been applied. However, there is one decision now which has come in the case of Metro and Metro, which is contrary to the Siemens judgment. But in the facts of that case, which is Metro and Metro, it was clearly demonstrated that there was involvement of human. There was a proper human intervention. Nevertheless, they deleted the addition on some other count, and they disagreed with Siemens, saying that we disagree with Siemens for reasons which we'll set out later. But if one really reads the order, there are no reasons set out as to why they are disagreeing with Siemens. In principle, they agreed that in the absence of human intervention, you cannot have technical services. What they could not believe was how can there not be a human intervention in that particular service. And I think the point which was missed out is the human intervention has to, again there are two kinds of human intervention, that of a human brain and that of a human hand. And what we are referring to in Siemens, which is a human brain and not just a human hand, because a human hand can be that of an office boy, a clerk, any kind of a peon or whatever. And I think that is one point which was taken note of in Siemens case. And therefore, I think we have a reasonably good case to argue that in case of type testing services which is rendered with the help of sophisticated technology, without much use of the human brain, it would not be fees for technical services even under the Act. And now I come to the last issue in this case study, which is Section 91. Now this is the only issue which we have really not argued. All the issues we are discussing have been practical cases which have been argued. This is a case where A Limited has earned income of rupees 60 crores from a project in Bhutan. I think in your case study it's written Afghanistan, but doesn't really matter. In financial year 12-13. However, on the said income it has paid tax in Bhutan. The said income of rupees 60 crores is included in its total income for the relevant assessment year. But it has had some losses in India, as a result of which the income assessed in India finally is 35 crores. Now, if one goes to Section 91, this is what Section 91 says. If any person who is resident in India in any previous year and proves that in respect of his income, which accrued or arose during that previous year outside India, he has paid in any country which there is no DTA, Bhutan, Afghanistan, whatever, income tax by deduction or otherwise, he shall be entitled to the deduction from the Indian income tax payable by him of a sum calculated on such doubly taxed income, at the Indian rate of tax or the rate of tax of that said country, whichever is lower. Now the issue arises here is to what does doubly taxed mean? He has earned 60 crores in Bhutan or Afghanistan. He has paid tax on 60 crores there. But in India, what is being taxed is, because he has losses, what has been taxed is 35 crores. On 35 crores, let's say his tax liability comes, for a moment, let's take 30%, which is 10.5 crores. In Bhutan or Afghanistan, let us say, he has paid 10% of 60 crores, which is 6 crores. Here the assessee says that as against 10.5 crores, give me a reduction of 6 crores and I want to pay 4.5 crores. The officer says, look, the section says the amount which is doubly taxed. So those 60 crores is taxed in Bhutan or Afghanistan, only 35 crores thereof has been effectively taxed in India, and you pay tax only on the 35 crores. So I will give you 10% of 35 crores, which is 3.5 crores. The issue therefore is, what does doubly taxed mean? Does doubly taxed income means income on which tax has been paid, or does doubly taxed income mean income which has been offered for taxation? The two are different. And we have one decision of the Mumbai tribunal wherein they have taken the view that doubly taxed income means income which has been offered for tax, though the tax has not been paid. And therefore in our case, one would really get the benefit of 6.5 crores, which is on 60 crores, though effectively only 35 crores has been taxed in India. I think with now we are back on the time frame and we can have our tea at the right time. Subject to Rajan Bhai's.
Thank you. Thank you, Sunil. As usual, brilliant analysis. 4 different issues covered in the less than 30 minutes. Okay. I think I fully agree with all the conclusions or observations made by Sunil. Just supplementary, as I was mentioning. As Sunil rightly mentioned, whenever we have to consider whether the benefit of the treaty is to be granted or no, we should always examine the commercial rationale of that entity in that country. I think this is becoming very, very crucial. And if we see that all recent trade of decisions, department is trying to argue not on the basis of whether you are eligible for treaty benefit or no, but whether you are entitled to benefit at all or no. So therefore, unless we establish that there was a commercial justification for establishing that entity in that country, then only the question of eligibility will be considered at that stage. As we rightly pointed out, Supreme Court in Vodafone, and if we see Sanofi's decision of AR, which partially reversed by the Andhra Pradesh High Court, these decisions need to be looked into. And particularly, as he rightly pointed out, it is very difficult to justify the Mauritius entity's existence or claiming a benefit of that. So whenever we, in fact, just to step back, we also need to examine, because facts are not there, but I assume facts are good on that case, as to when we consider Netherlands, whether I am entitled to Netherlands benefit also. Whether Netherlands was SPV, whether it is introduced when, was it having all approvals from the government of India, whether the board has been managing from there, because it is again a subsidiary of a UK company. So therefore, even to check, and this is how the department is now examining, not only Mauritius, they will go back to the Netherlands, find out the what we call a clinical test of the Netherlands company, whether that can be justified as validly incorporated entity, not the only pass-through entity from the Netherlands. So therefore, these need to be very, very carefully checked before we come to any conclusion. As Sunil rightly said, since assuming that all the tests are satisfied, Netherlands company is validly established there, commercial justification there, then Netherlands treaty benefit will be available. Now coming to the controller management, as Sunil rightly mentioned, when we are considering the control management, we have to see the controller management wholly in India. So merely because at particular time, the transaction, the controller management, as rightly put in the facts, at that period only Indian one director was there, that is not relevant. Because if throughout the year Mauritius company is having control management outside of India, then I think we will be able to get the credit of Netherlands treaty. Now as far as the second point is concerned, I think we need, as he rightly pointed out, dividend, whether this is a hotly debated topic, because several cases have been, matter has been examined under the different treaties. And as he rightly said, we need to examine under this, and this is, he validly put it, all the points I think need to be considered. So far, we have not been able to get a success, though strongly recommended by many councils that yes, you should pursue this matter and don't give up saying that this is not eligible for. So the tax credit, what we are talking about, is being pursued at various forums and which is pending. So far, though we don't have success yet on directly on this issue, but I think we as a litigator never give up any hopes, because what will appeal to what judge, nobody knows at any forum. So that is how we have to keep arguing those issues. Now coming to the third point, certification charges, he rightly mentioned that there are a host of decisions to say that this is nothing but a fees for technical services as per section 917. So therefore, it is chargeable to tax in India. Two thoughts, just going from what we discussed from Kanchun's case study and here. Predominantly, if we see, what is done is everything services are rendered through a mechanical process. It is a standard process which is used for examining your test and give the certificate to you. No advice is given by them to you. So, is it possible for us to argue that this is nothing but a business income of a German company accruing in Germany and not in India? And why this gets support further is, if you see some of the decisions starting from Ashapuras, which I had lost in the tribunal, recently by the same judge has been reversed by him. So therefore, I think Agra bench, he has reversed the judgment and he said that I had taken the wrong view at that point of time. So therefore, I think, as I was saying, never to give up, and this has now come to the conclusion saying that this is business income and this is not fees for technical service. As Sunil rightly mentioned it, Human intervention or not intervention is a later part. But first, merely because it is with the technology backed or machinery backed does not mean that this is a technical service. And what is technical has been series of decisions to justify what is technical service. So therefore, it can be easily said, giving a blood test report or giving an X-ray report does not mean that it is giving any technical services to you, and therefore it is not liable to that. So therefore, again, as I said, as Sunil also rightly pointed out, we need to consider and agitate. Only as he pointed out, we have to be careful on the treaty. German treaty is very, very restrictive for FTS purpose, and therefore it is almost similar to our 917, so therefore that is not much of a benefit available. We need to keep track of many mutual agreement procedures, because MFN clause has been introduced in many of the countries, but unfortunately is absent in Germany. If it was MFN clause was there in Germany, like it has in France or many other countries, you could have taken the benefit of make available, inserted here for rate and scope of the provision, and you could have got the benefit of that also. In case it is held to be FTS, then it is not making available any knowledge. So all those decisions are clinical trial decisions like OCART and all those decisions which are there, that Anapharma, OCART, all those decisions could be available. The mayor certification does not amount to FTS and definitely not making available. So that is the point I think we could consider. As far as the fourth issue which is touched upon is regarding the taxes paid, I fully agree. Only we should keep in mind there are two Bombay High Court decisions, I think it is approved by the Supreme Court, where it was a question of a double taxation and where the exemption was granted. One is a losses set off, second is a expenditure, and third is exemption granted. Suppose a particular income is doubly taxed and you are eligible for some ATO deduction. I remember the case of Bombay High Court of ATO deduction. Bombay High Court said what is chargeable is the net amount, not the gross amount. And therefore Bombay High Court had taken a view, you will get deduction only on the smaller amount and not on the gross amount. But again, as I said, we need to keep the issues alive, whether it is an expenditure, set off of losses, or everything could be possible. And I think department also has recognized that because of the difference of the year, financial years versus calendar year, if the taxes are falling in different years, you should still be eligible for, so long as taxes have been paid and you give the certificate of taxes paid, not on the basis of rate of tax in that country. So therefore, this has been department has been taking little softer view on not necessarily the assessment year, and so long as tax has been paid on that. So that is these are the few thoughts on this. I think friends, we have slightly overshot on the first two case studies, but I think we will be able to catch up with the remaining 4 case studies in the time permissible to us. And so my request is we'll break for the tea for 15 minutes, but please try to come as early as possible. If need be, you carry your tea cups, tea mugs in the table, and we can start it as early as possible. Thank you.